What's going on, ladies and gentlemen? Welcome back to another video, and thank you guys once again for tuning in. So a couple months back, I actually made a video regarding gold and talked a little bit about silver. And in that video, I was discussing the potential for gold and silver prices to increase, considering that we're kind of going into an economic slowdown. And as many of you guys know, whenever there's a little bit of uncertainty in the market or people are a little bit fearful of a market recession, a crash, or a bear market, or in general just a downturn in the overall market, a lot of investors and traders will seek a safe haven, and a lot of those are going to be areas of precious metals like gold, silver, etc. So a couple weeks back or a couple months back, I made a video regarding gold and regarding silver and said it's probably time to start buying gold. Since then, gold has actually gone on a really nice run and it's starting to form into a really nice bullish trend. So since that video was a couple months back, I figured I'd come out and make a new updated video showing you guys just exactly where gold is sitting today and how it's been performing and touching a little bit on the market as well. So right now I'm going to go ahead and start sharing my screen. That way we can look at some of the charts. We'll look at the S&P 500, we'll look at the price of silver, and we'll look at the price of gold. And in this video, I'm going to show you guys two of my particularly favorite silver and gold ETFs that I particularly invest in. So let's get right into it. So here we are. Right now what we're looking at is an intraday chart on GLD. So GLD is the ticker symbol for basically my favorite gold ETF. So for myself, I don't truly trade the gold futures. What I invest in is the Spider Gold ETF, and the ticker symbol is GLD. So what we're going to do just real quick, we're going to take a look at a one-year chart. So on this one-year chart, you're going to start seeing some really nice formations and really nice breakout. All right. So if we look at the chart, you can clearly see just over the past months, gold has gone on an extraordinary run. When I made the video about gold potentially breaking out, I believe the price was around $120. I will link that video in the description of this video if you'd like to go back and take a look at that video as well. That was discussing this before gold had actually started going on a run. So I'll link that video in the description. But as we can see here, GLD is starting to move very significantly in the upwards direction. And as many of you know, anytime the markets, might be getting a little shaky, a lot of people start to invest or aim towards gold and silver. So my question for you is, if gold is naturally a safe haven or a hedge against a downward move in the market, and we're starting to see extreme buying volume coming into gold, what do you think is probably going to be the outcome of the market over the next year to 2 or 3 years? Of course, these things don't happen overnight and they happen on a slower pace, but it's safe to say now that with the amount of volume and buying pressure coming into gold and into some of these precious metals, it's really starting to give us that feel that the markets could be going towards some bearish times. I mean, after all, the market's been at an all-time high for about 2 years and it hasn't really pushed much higher than where it's been at for the past 2 years. We've tried to break into new highs. Every time we break into new highs, we tend to sell right back down into the trading range where we've really been out for the past 2 years. So the markets haven't really made any significant gains from the year of 2017 to where we currently stand in 2019. Now, if you look at every single dip and every single jump that the market's made, then yes, there has been some significant gains in the market based on where the entry would have been. But as a wide spectrum or a broad overview from really the top that we made in 2017 to where we're currently at now in 2019, the market's really made no gain. So for a lot of those investors out there or a lot of the traders that keep talking about the market's pushing into new highs and everybody's missing out on this bull run, well, truly, there hasn't really been any significant movement since 2017. You've been having really highs and low swings, but really no further push into new highs. And with that being said, we're starting to see a lot of volume picking up in some of these precious metals. So what we're seeing here is just a one-year chart, and you can clearly see that it's really been breaking out very nicely here. So what we're going to do now is we're going to take a look at a larger time frame. We're going to go all the way back to 20 years, and we're going to put on a 20-year weekly chart. So when we go back to a 20-year weekly chart, let's start looking at the history of this particular ETF or gold ETF. So if we go all the way back to where my cursor is at, This is in 2007 and 2008. And you can see that there was very similar formation, and I'm going to map this out. If you guys give me just a second, I want to draw on this chart. So if we look back where our cursor's at, this is in 2005, 2006, going into 2008. So right here, this 2007, 2008 period that I'm hovering over, that was when the market went through the '08 recession, the Great Recession, terrible economic time. And you'll actually see that gold was going down as well. But it was just after 2008 that gold went on an extremely big bullish run. So it actually took about a year's time for gold to pick up after the initial downturn within the 2008 Great Recession. All right, so if we look now, the charts are forming a little bit different, and what we're looking at now is a bigger time frame trade rather than a shorter one, and I'll explain. So if we look back at the beginning of 2006, I'm just going to draw a simple pattern here. This is what we call like a bullish pennant breakout, okay? So you can see the chart formed into a little bit of a triangular, formation, and then it broke out. If we go over today, you're starting to see something very similar, where we're getting this kind of upwards channeling triangle, and we're starting to break out. But the difference here is we had a really big run up. Okay, so take for example, back in 2008, we went through recession. Then after that, gold went on a massive bullish run, and you could probably assume why. After 2008, the housing market crashed. Everybody was losing money. Investors were losing money. So there was an extreme rush into a safe haven of gold, which obviously performed far better than the markets did throughout 2007, throughout 2008, throughout 2009, and probably even relatively into 2010. The bull run of gold didn't really stop until about 2011, and then we kind of went through a little bit of a bearish market in gold. Since then, gold has started to sustain itself right around the $1,100, $1,300 price point, if you're talking about the futures. In this particular ETF, gold ended up holding right around $100, and it kept rallying from about $100 to $1,300, right? 130. Couldn't break over that. Just recently, we have now started breaking over a long-term resistance level of 130 or 1,300. And now we're starting to press into 140. So again, gold's performing very well. So if we take into consideration what happened back into '08 when we had the housing market bubble, and we take a look at how gold's performing now, it's possible that the prices of gold are just increasing because there's volume flowing into gold as a hedge against a potential downturn in the market. That's what a lot of big institutions and just regular investors do, is just hedge, right? They start to buy and accumulate some gold while still holding majority of their equities or some type of long-term position. But many people know that as we're going into a recession or a potential recession, the likelihood that their equities or stocks lose more value is greater, and the likelihood that gold performs or outperforms some of their stocks is going to be greater. So they'll start to buy gold, or they'll deleverage some of their equity or stock positions and put some of that money into the precious metals market, because they know that that's probably going to perform a little bit better if we do go into bearish times, and that can help offset some of the losses that they acquire through some of their equities, or depending on how leveraged they might be or how hedged they might be, they might come out break even, or they might even make some money, but that's all up for debate on how someone will actually do so. But what we're seeing now is a for sure solid breakout in the gold market, and what it appears to be is the start of a bullish trend in the gold market. So now let's think. The stock market's been on a bull run for arguably 10 to 12 years, coming up maybe to even 13 years, and we haven't really had any recession. We haven't really had any big economic downturn. Fingers crossed that we keep going, but to keep going would be naive. We don't want to be naive investors. We want to be intelligent investors, like the book written by Benjamin Graham, right? We want to be intelligent investors. And the signs that we're starting to see in the market is a slowdown. The signs that we're starting to see in technical charting analysis is we're starting to see bearish moves making way into the S&P 500 and some of the bigger indexes like the Dow Jones or the NASDAQ. So we're starting to see some bearish signals within the charting formation, and we're starting to see bullish formations within the precious metals. So it seems to appear that a lot of signals are adding up that the market's going to go into recession. Many of you guys know that there's been talks of this. Now, I don't want to be the doom and gloom guy that says that the market's just going to burn and everything's going to end, but let's be honest here. We've been on a bull run for 12 years. President Trump and China have been in a massive trade war. Trade war really isn't good for either country. Nobody really wins in a trade war. A lot of the consumers of each country end up making up the difference or really taking the true hit of the tariff and trade war that's going on. The Federal Reserve just started cutting interest rates since 2008. 2008 or 2007 era was the first time that the Fed started to really cut rates. And what happened is they kept cutting rates all the way until interest rates went down to zero. Right now, we just had our first interest rate cut in basically since the last big economic crash. And the problem is, if the markets do continue to go into bearish sentiment, then the likelihood that the Federal Reserve actually cuts interest rates again is very likely. And the reason they would try to cut interest rates is obviously in accordance with their monetary policy. But a lot of investors and traders see that an interest rate cut to the market is a way to try and continuously stimulate the market. So back in 08, we had to go through vigorous interest rates cutting to really try to cool the market and keep it from going down. And now we started our first interest rate cut, which was also implied from President Trump. So if you think about it, it's not really good that our president has some sort of sway over what the Federal Reserve does. Now, even the Federal Reserve says that Trump doesn't really impose on any of the decisions that the Federal Reserve makes in regards to their monetary policy, but we all know that's kind of bullshit because just a couple days ago, President Trump, or the past month, President Trump was talking about giving an interest rate cut to the market, and sure enough, the Federal Reserve did. Now, whether or not the Federal Reserve did it because President Trump said so, or the Federal Reserve did it because they feel that it's the best decision in regards to their monetary policy, the world may never know. I mean, tell me how many licks it takes to get to the center of the Tootsie Pop, but again, the world may just never know. So what we're seeing right now is a bullish formation and breakout within the gold markets, and we've mentioned this for the past 2 years on our channel, that this is something that you guys should probably start focusing on, is things like gold and silver, because the prices are so far undervalued, or they are very cheap in regards to many of the equities out there, that it just doesn't seem like the risk to reward is quite there in the equities market, whereas right now it actually seems better in the precious metals market. So if we look at this chart here, again, we're starting to see a very solid bullish breakout. As many of you guys know, in trading, there's formations called double tops, where price action tops out at a certain level, and then it goes through a downward turn, and then eventually it returns back to that same high to test it to see if it can go higher. And I truly believe over the course of the next 3 to 4 years, we're going to see the price of our GLD Spider ETF, gold ETF, reach prices of about 180 to 190 and possibly beyond, depending on how bad our next economic downturn will be. And to think that there isn't going to be another economic downturn would be very naive. There will be another economic downturn, and it can be very ugly. If you guys know anything about debt levels and how debt works, our country is really built on debt, which basically means we were built on air. We're not built off of anything that's true. There's a lot of debt, and when that debt needs to be repaid, bad things can happen if it all occurs right at once. So this is a chart of GLD, and this is a chart of gold. What I want to show you are the gold futures now. If any of you guys are investors or have been doing this for a long time or are traders, you guys will know that a very, very important thing to investing and trading is to make sure that whatever it is you're planning on investing in or things that you're planning on trading need to have significant share volume or volume within that specific, financial security or equity or ETF or whatever it may be. You need a lot of volume, because volume tells you the story. And I always use this example, right? When it comes to trading stocks, you want to find stocks with really high volume or volume that's picking up. And that's the same thing in everyday life when you're going to a party or you're going to an event. Is it going to be a lot of fun if you go to a party that nobody's at? If you arrive to a party and there's like 2 people there and a punch bowl and maybe a little, bowl of Cheetos? That's not fun. You want to go to a party where there's going to be DJ, there's going to be music, there's going to be people dancing, there's going to be drinks, hopefully they're free and the bar's open, right? But you want to go to a party where a lot of people are at and there's a livelihood to it, right? You don't want to be at a party where no one's at. So when it comes to investing and trading, you want to follow the volume. The volume tells you where the money's flowing. And if you look at the chart on the gold futures here, which is /GC, you are going to see something very interesting. Look at the significant volume increase that's been pushing into gold. I mean, it's a no-brainer. Look at the volume increase. It has been massive. It's been picking up since 2015, going into 2017 and 18. And as many of you guys know, 2017 was really the first big initial scare at the top of the market that we had. And look what happened in 2017. 2017, we started to see enormous spikes in volume to the gold. Even though the prices didn't rise, we were starting to see significant buying volume there. Then throughout 2018, the market kind of went through a downturn, then it pressed into new highs, and now look what's happening to the volume here. The volume is increasing even higher than what it was in 2017, and yet the market still is at all-time highs. So we're seeing significant buying volume starting to come into gold right now, even while markets are at all-time highs. And why do you think that's the case? Because people realize what's going to happen before it happens, right? People start to build these ideas in their head of what can happen, and then they start to plan for it. And that's how you become an intelligent investor. You look at the risk versus the reward in the market, and right now, the reward is very low and the risk is very high. Whereas somewhere like gold, the reward is much higher than the risk, because the likelihood we go through an economic downturn is greater than the S&P 500 blowing through all-time highs and continues to scorch for years to come. The likelihood of a recession is greater than the likelihood the market continues just to fly. And with that being said, you know that equities are most likely going to decrease in value and precious metals are most likely going to increase. So even if the market hasn't fully turned and started showing us really, really negative signs, people are preparing for what's to come, which makes sense as to why we're starting to see significant buying volume come into the gold market without even having a really bad economic downturn just yet. It appears that people are preparing. You can also do research based on China and a few other countries. They've been buying up boatloads of gold for many years. Why would countries be buying up significant amounts of gold never seen before if they didn't want to own it for some reason? Things to ask yourself. Now let's take a look at SLV. So SLV is another ticker that I particularly like. It's a silver-based ETF. So let's take a look what happened back in 2007, 2008, you're going to see that silver went through kind of a really bearish move. And then afterwards, silver went flying up into 2010, very similar to what gold did. So if you haven't noticed by now, just by looking at the charts, if you go back and look at gold and you look at silver, silver tends to lag the price of gold. It's just the way it is. More people are prone to buying gold in bad times than they are silver. So when the gold markets pick up, then the silver markets start to pick up. Okay, so silver tends to be more lagging than the gold move, but it still moves. So what we're seeing here too as well is that silver is starting to pick up down here on the bottom. Now I know this is very far from the top of $48 here back some 10 years ago, but we're starting to see very bullish signs. If you look, since 2014, silver has stayed pretty consistent in pricing and hasn't truly decreased in value. So if it can't go lower, it's probably going higher. So again, what we've been seeing is silver has been holding this $14 level for 6 years. And now we're starting to show some bullish formation to the upside. And notice what's happening to the volume. the volume here is starting to increase as it is in gold. So not only are we seeing prices increase in gold and volume increase in gold, we're starting to see volume increase in silver and prices increase in silver, okay? So these are some definite things to pay attention to. And again, I will leave a video linked in the description of the past video I made about gold back when I said it was probably time to start getting invested into gold. Now let's take a look at the S&P. I generally look at the SPY because it is one of the most heavily traded ETFs within the stock market. And something else I want to point out. Okay? As I said before, volume supersedes everything. Volume is a sure indicator of what prices are probably going to do. So as you can see, back in 2008, 2007, we started to go through a bear market, right? And you can see a ton of volume came in at the low point of this bear market. And it's no surprise because when prices were that low, who in the hell wouldn't want to buy up the market? So you started seeing significant buying volume come in at the low here at $67, okay? Now, what we've been seeing as the market is getting up into these all-time highs, really what we're seeing is significantly less volume. So that tells us that less people are partaking in the market at these higher prices. And if less people are participating, then the markets cannot continue to go higher, or it's going to take a lot more time for them to move higher. Because again, you need volume to continue having prices go higher. Without the buying volume, the market won't push higher. And all we've been seeing is really decreasing volume a little bit, okay? Decreasing volume. Now, what I want to take a look at is the chart again. And I'm actually going to add a specific tool that I need for this onto our chart. Oh, I already had it on there, didn't see it. Okay, so what we want to take a look at now is the relative strength index. What we're putting on the bottom of this chart is a couple little lines bouncing around down here where the cursor's at. This is the relative strength index. The relative strength index is just a momentum indicator helping you kind of track momentum and sort of things like that. But one thing that RSI can tell you is it can kind of give you an idea of when prices of something might increase or decrease based on something called a divergence. A divergence in the stock market is when price action is telling us one thing, but momentum is telling us something else. And I'll show you what I mean. So back here, this is the beginning of 2018, we had this drop. Okay, this was a market high. So from this high to this high, the market was trending up. But the momentum from this high to this high was trending down, which then led to a big market move to the downside. We are seeing the same thing happening right now. From this high to this high, we are seeing decreased momentum. It's not as significant nor as big as the previous one, but we are seeing it. We are seeing some negative momentum in the market while prices are still pushing into all-time highs. And if we just take a look at the whole thing, we could say this market's trying to been trending into new highs while the momentum the whole time has truly been trending down. So what we've been seeing is a struggle to truly break over highs. And if I may, look at the top back here in 2018, beginning of 2018, right there. Look at the high. So for those investors out there and traders, and you hear them all the time saying the market's killing it, the market's going to rip, the market's going to roar, it's going to do this, it's going to do that, just know that to date, right now, today, the market has made zero gain since the beginning of 2018. No gain. Some of you are going to say that's not true, but in fact it is. Because if you look at the price of the first initial scare that we had in 2018, the price of the S&P here was at 286. If you look at where the price of the S&P lies today, it's just below 286. So again, the market has made zero gain since 2018. There has been moments where the market's been gaining, But since the first initial scare of 2018, when a lot of the talks came of recession and it's been hitting headlines and more people are talking about an economic downturn, there's been zero gain. Do you think that's coincidence? Probably not. Sure, from the beginning of 2018 into 2019, the market actually increased significantly. If you look, the market's actually jumped a total of 30%. But from 2018 to now, the market's actually down maybe about 1%. So again, what this is showing us is that the market so far does not like these all-time high levels that we've been resting at for almost 2.5 years. If you look at it from low to high, the market's really been in the same channel the whole time. Actually, let me redo that. From the 2018 scare to the low of this 2018 December move, you'll see that the market really hasn't gone much higher. It's been in the same position. So if you've been a long-term kind of just sit and hold, you've really made no money since the beginning of 2018. If you were an investor who also trades in times markets, then you could have made significant gains by buying the dip here in 2018 and riding it to a high here and shorting the market like we did down to the December lows. And then also if you're an investor who bought the dip here, you would have made a great gain. But if you're a buy and hold strategist here, you'd be making nothing. You would have had basically zero gain other than dividend payouts, of course. So again, I really wanted to come out and make this video just to inform some of you guys and give you guys a little bit of a perspective of what's really going on in the markets. Gold is going up like crazy. The volume is picked up like crazy. Silver is performing very well. The volume is picked up there. People don't just buy gold and silver to buy gold and silver. They buy it as a hedge against a market downturn, or they buy it, again, as a hedge to make money when the markets go into a downturn. So the question remains, and the question I will ask you guys, and I would love to hear your comments in the section below, because we know for a fact that there are going to be many people out there that think there's a huge downturn coming. There's going to be some that think there's just a recession, and there's some that are going to call for the market to blow all the way to 3,500 or wherever. So I'd really love to hear from you guys in the comment section below what you truly feel is going to happen and what you think the Federal Reserve is going to be doing with interest rates here in the future. And do you think that the market's going to go through an economic downturn? And do you feel the same as me that it's time to be buying and investing in gold and silver? So let me know what you guys think in the comment section below. And as always, make sure to give the video a thumbs up. It takes a lot of time to do these videos and a lot of work. And the more thumbs up we get on the videos, the wider these videos reach our audience and the more people we can reach to inform about the markets and situations that are taking place right now. So thank you guys again for tuning in as always, and I will see you guys in the next video. Everybody, take care.